Greetings, members one and all of the Salivation Nation. A record amount of physical gold is being delivered on the COMEX, changing hands for sure. A lot of records have been broken in 2020 for sure. Let's explore. That's right, this is a story that's been shared with me by several members of the community, including Bama, 17NC, and Chuck and Plata, among others. You know, I do try to credit those of you who share articles with me. Many times I get duplicate information, so I don't always get all the names, but I certainly do appreciate you guys taking the time. And before we start, make sure to gently caress, be very, very careful with that like button as you press it, as it does help get the word out. Very much appreciated. So this story here is actually from last week. 102 tons of gold changing hands on CME's biggest ever delivery day. Yes, indeed. COMEX exchanges in New York said on Thursday they would deliver 102 tons of gold to holders of expiring futures contracts in the biggest one-day delivery on record. The bumper number underlines a dramatic change on COMEX since March, in the story from Reuters, when the coronavirus crisis weakened links between New York, the world's main gold futures trading venue, and London, the biggest center for storing and trading physical bullion. This is sort of a repeat of a story that I did earlier, but it's continuing and it's breaking records again. But some people had questioned, if this really was true, or if it was what it was covering, if it was trying to cover some positions or what have you, or it's some sort of normalcy. But we'll kind of get into that here later. The assumption that gold would be quickly shipped from from London to New York to settle contracts broke down when lockdowns grounded passenger planes used to transport it and closed refineries that shape metal to fit CME specifications. Since then, futures prices have typically been higher than gold prices elsewhere in the world, incentivizing traders to ship metal to New York to profit on the difference. Stockpiles in COMEX registered vaults of gold deliverable against the exchange's main contract have leaped to 1,016 tons from 276 tons in late March, CME data show. Deliveries against active contracts have soared from just 8,234 contracts representing 26 tons of gold in February to 31,666 contracts, which is 98 tons in April, and 55,102 contracts, or 171 tons, in June. On Thursdays, traders said they intended to deliver against 32,732 contracts expiring in August, according to the CME. Some 47,236 contracts were still active on Friday that will either be delivered against by the end of August or swapped for contracts expiring in later months. And the swapping is something that has been going on. There's complexity to that level too. But in this article here from Zero Hedge, it talks a little bit about why and the how of what's going on here. Traders on the main gold futures exchanges in New York issued the largest daily physical delivery notice on record. This article dated the 2nd of August here. In the latest sign of how the market norms have been upended by the price disconnect that struck in March, Bloomberg reports that traders on Thursday declared their intent to deliver 3.27 million ounces, over 100 tons of gold, against the August COMEX contract, the largest daily notice in Bourse data going back to 1994. While millions of ounces of gold trade on the futures market every day, typically only a tiny fraction of that goes to delivery. But in recent months, huge amounts of bullion have flowed into New York, and the COMEX has seen record deliveries. And here we can see the COMEX delivery by tonnage through a particular time. You can see here 102 breaks a record. We last saw something relatively close, well above there, way back between 2005, 2006 period here. So here we have another chart showing the frequency here of the delivery contracts. And we can see that it is well above everything else. Jan Nieuwenhuis of VMA Gold explains 3 elements cause physical delivery on the COMEX that have reached record highs this year. This is very interesting and important. A strong demand for futures in New York, a persisting spread between the prices of futures in New York versus spot gold in London, and arbitrage. So physical delivery on the largest gold futures exchange in the world, the COMEX in New York, has reached all-time highs this year. Usually, delivery is negligible. So what has changed? There's been an important change in the global gold market occurred on March 23rd, 2020. On that day, the price of gold futures in New York started drifting higher than the price of spot gold in London. Ever since, the spread has persisted. Although it continuously widens and narrows, the reason for this disturbance in the market can be read in the previous article about what has caused the New York and versus London spot price spread and why it persists. To understand the shift in deliveries, first let's take a look at how the global gold market operated before the 23rd of March when things ran smoothly. Before we get into that, there used to be a website called Has the System Failed? And it had the arbitrage between the Asian and New York markets and London markets. And if it spread apart too much, then that would mean there was more likelihood of a chance of it failing. Well, we're seeing this now between the London markets and the New York markets, this arbitrage here. So here's how it worked before March 23rd, 2020. The world's most dominant gold spot price market is the London bullion market, where mostly local London gold is traded, meaning the metal is physically settled within the environs of the M25 London Orbital Motorway. The most dominant gold futures market is located in New York, where metal can be physically delivered within a 150-mile radius of the city of New York. That is under the Fed, and they say there's a lot of gold down there. I think it's the second largest gold store behind Fort Knox itself. Before the March 23rd, the price in London spot and the price in New York near-month futures contract always traded in tight lockstep because of arbitrage. If, for example, the futures prices would trade above spot, arbitrageurs would buy spot and sell futures until the spread was closed. Arbitrageurs would hold their positions long spot, short futures until maturity of the futures contract, because at expiry, the price of the futures contract was guaranteed to converge with the spot price. That's very important. An example here. We can see the strong demand in New York would be translated into spot buying in London. Worth noting is that when a futures trader rolled his position into the next month, and his initial futures buying was translated into spot buying in London by an arbitrager, on a systematic level, the arbitrager would roll its position as well. Of course, the opposite happened as well. When futures traded below spot, arbitrageurs would buy futures and sell spot until the spread was closed. So far, a simplified version of the market before the March 23rd. In other words, there's probably a little bit more complexity involved in that process that we saw. And that is the gold market, which is a relatively small market to some extent, but it's still big, much bigger than the silver market. So there's probably a lot more of this stuff happening which could be studied for the silver market. I think that's probably one reason why some people feel like there's more manipulation involving the silver market than the gold market. So what happens after the 23rd of March of 2020? Well, since then, futures have persistently been trading above spot, though the spread isn't constant. As a result, arbitrageurs aren't assured that the futures price in New York will converge with the spot price in London. An arbitrage trade, as described above, through a position in both markets incurs risk. What arbitrageurs currently do to profit from the spread is buy spot, sell futures, fly the metal to New York, and physically deliver the gold. This is how the profit is locked in. If the spread between spot and futures is $40 per ounce, the arbitrager's profit is $40 minus cost for transport, insurance, storage, etc. Now you can see why the persistent spread between New York and London has increased physical delivery on the COMEX through arbitrage. That makes a little bit more sense here. And here we have a chart that kind of explains this. So in the conclusion of this, physical delivery on the COMEX is elevated because of the current unusual situation in the global gold market. The gold delivered in New York has been imported from spot markets such as Singapore, Switzerland, and Australia. Now we know those sound familiar because there's been a lot that has been going on there. In fact, Australia, the Perth Mint, is under investigation. We've talked about that. And of course, Switzerland has been having some issues because of COVID being shut down as well. U.S. imports directly from the UK are rare because in London, 400-ounce bars are traded, and the main futures contract in New York requires smaller bars for delivery. From Jan Nguyen, I'm not pronouncing that right, but I've covered some of his material before. He says, if anything, when gold futures traded higher than spot, the futures market pulls the price of gold upward. So you might wonder who takes delivery from arbitragers that make delivery on the COMEX. Possibly these are arbitragers too. In the chart below, you can see the spread between the near month futures contract and the next near month futures contract. The spread has also blown out on March the 23rd. Arbitragers can buy the near month and sell the next near month for a higher price. Subsequently, they take delivery on the near dated contract and make delivery of the future dated contract. And here we can see an example of that. At the time of writing, near month August is trading at 1,973, while the most active month in December trades at $1,994. So this is where the futures market is, where gold is expanded upon, getting very close to that $2,000 level amount. Arbitragers can buy long August and sell short December to collect $21 per ounce. One reason I can think of as why the spread persists is because bullion banks are currently less active on the COMEX. Previously, bullion banks, having access to cheap funding, often performed the arbitrage trades. So very interesting indeed. Less active on the COMEX. Some people think the COMEX is corrupt, and physical delivery is a way to kind of back it up, so to speak. Very interesting and fascinating information there for these record deliveries on the COMEX. So thanks again for those of you who did send me some information about this. There is an article here on, and this is the actual sourced article from Seeking Alpha from Jan that does talk about this and goes through all of these situations here. I don't think there's anything else extra on here that shows that. Very, very fascinating indeed. So what do you think about this? And there's that spread. That's why I think this is part of the reason why I believe some of these bullion dealers are quoting futures prices, why the spot prices are higher than the actual, or the spot prices they quote are from a combination of futures and other data, at least from what I understand when I asked the question from a bullion dealer. And very interesting indeed. So post your thoughts below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and I encourage you to please rate, share, comment, and subscribe.